So good morning. We had to cope with a very, very difficult environment and very difficult year last year for industrial and precious metals due to various factors. First of all, the COVID and the post-COVID rebound, the war in Ukraine, the change in the monetary policies, the zero-COVID policy and the real estate crisis in China. So a very difficult environment which has impacted a lot the metals market worldwide. So the idea of this webinar today is to give you our insight and our market outlook for 2023 on this specific market. I'm here today with Benjamin Louvet and Marion Balestier to answer your questions and concerns. So the first question is for Marion. So Marion, you seem to be very optimistic. In fact, what are the macro views?
Yes, so thank you, Christophe. As you said, 2022 was a complex year for investors, and metals markets were no exception. We had negative factors kind of piling up for metals demand. You mentioned the Federal Reserve massive tightening this year, and of course there was also China, which kind of reinforced its sanitary restrictions, and the property market kind of collapsed this year. So all this was, of course, a bit of pressure for demand, and this resulted in investor sentiment and financial positioning turning very defensive this year. What's very interesting is that the physical markets show a completely different picture, because they actually became tighter than ever. We, for example, saw inventories collapse further this year, and they are standing on historically low levels right now for metals. So this is mainly explained by the fact that demand was constrained, but supply was also very constrained this year. And we have a bunch of factors to explain that. The first one, of course, is geopolitical factors. Russia's a big producer for namely nickel and palladium. And so there was a bit of disruption in exports. The energy crisis in Europe also explained the disruption, namely on aluminum and zinc, because we had energy prices sharply up this year, and this resulted in smelter closures all around Europe. So clearly that affected production. And most of all, we have a structural constraint on supply, because investments are really under-dimensioned, and they are pressuring production. They have been pressuring production for years, and we really think they are lower than what they should be, considering what we expect for future demand for metals. So you were asking what are the reasons for us to be for us to be constructive this year. The first one is that the Federal Reserve could actually be close to its so-called pivot moment, which could lead to more downward pressure on real rates and on the dollar, which of course would be a very good support for metals prices, and especially for precious metals prices. The second factor, of course, is China. And I mean, China is reopening its economy much faster than we had previously anticipated. So right now we have this very massive epidemic wave, but we should also see after that a very strong recovery in activity. And the important point to note is that we are not just anticipating a short-term rebound in activity led by the reopening of the economy. We are expecting a much more sustained rebound. And this is because the government's attitude toward the growth and its domestic economy has entirely changed in the past few months. So we are really expecting policies to be much more pro-growth. So economic, monetary, and regulatory approach should really gather to support this economic rebound. We are actually seeing the first signs of recovery emerging right now. We're seeing mobility improve across the cities, and we are also seeing a very encouraging signs on the property market side with lands and houses sales rebounding for the first time in the past 16 months. So this is very encouraging for metals demand, especially as China represents roughly 50% of all metals demand. So clearly this paints a much brighter picture for 2023. And this cyclical rebound is, as I was saying, combined with a very tight physical market.
Mm-hmm. Okay, thank you very much. Benjamin, do you have also structural events that have impacted or that can impact also this situation for metals?
Yeah, of course, Christophe. What comes in complement to what Marion said just right now about China is also the fact that today it's I think quite obvious to anybody that we have no choice but we have to transition from a fossil fuel economy to a renewable economy, and so we would have to develop a lot more renewables in the coming years, and people realize that you can't make electricity with wind or sun. Okay, to make electricity with wind or sun, you need a transformer which will convert the energy of wind or sun into electricity, and this transformer, this converter, is made mainly of metals. So you have, for example, between 950 kilos and 5 tons of copper in a wind turbine, depending on its size. You have 4 times more copper in an electric vehicle than in the internal combustion engine vehicle. So definitely transitioning from fossil fuels to renewable means that we will transform our dependency to fossil fuels into a dependency to metals, and we are not really ready for this. This was already shown this year in the figures we got from China. As Mario mentioned, the property market was really bad this year, and so the demand for copper, for example, went sharply down this year by 450,000 tons. But at the same time, China accelerated on renewable capacity installation, and so the demand in green technologies in China went up by 550,000 tons. And so as a whole, the China copper consumption this year went up by 100,000 tons. And so the copper demand in this context of recession, of zero COVID policy affecting the economy, the final count is that Chinese copper demand went up in this year. Imagine what can happen in a year where the economy is completely reopened. And this is what we think we will see in the coming years. By the way, we are talking about China, but when you look at figures for Europe this year, the demand for metals this year was up also in Europe, even if we were in a situation where the economy was not that good because of all the constraints that we have now and all the changes in the monetary policy. So you can see also on this graph that it is the same for the US. The thing is that even if renewables accelerated a lot this year, they will keep accelerating in the coming years. The International Energy Agency just published a report saying that in 2020 we installed 130 gigawatts of solar panels around the world. The year after it was 160, and in 2022 it was 180 gigawatts. They say that in 2027 we will install 275 gigawatts a year. Mm-hmm. So that means that we will need far more metals. And in another report published by the International Energy Agency last week, they explained that if you consider the time needed to create a new mine, which is, by the way, on average worldwide 17 years, if we want to be ready to have enough metals for the energy transition, for the example of copper, we have to start new mines before 2025. You have to know that today, the last projects that are settled for copper are set to start in 2024. There is nothing else after in the book in terms of project developments for copper. So we are really in a hurry. We will need more and more metals, and at the same time, we have a constraint on the supply. And as Marion mentioned, inventories are at historical lows. So it will be really difficult to cope with this situation. The only way to cope with it is to see prices going up.
Okay, thanks a lot. So at Ophi Invest, in your team, you manage two main products, one on precious metals, another one on the energy strategic metals. So maybe let's focus first on the industrial metal, the base metal. So my first question is for you. I think Benjamin has already talked about copper. So can we talk about the structural changes and for this market? And can you give us maybe your insight and on certain metals and of course copper and nickel, for instance?
Sure. Yeah. Well, we can give you those example where the copper is one metals that we often mention because first it's everywhere in our today's economy, right? From your toaster to computer chips. And it's going to be hugely emblematic to the energy transition as well, because it's necessary in almost all low carbon technologies. And it's this transition related demand is actually growing much more rapidly than we anticipated, which is pushing analysts to revise their projection on the upside almost on a yearly basis. That's what we are seeing on this chart on the left of this slide. I mean, Benjamin already mentioned this very surprising resilience in copper demand, especially in China this year, which was a huge surprise even to us because, I mean, the slowdown, especially on the property market, was very important. So, and the prices reflected a huge drop, and so it was very surprising to see how demand actually resisted and how the transition-related demand was enough to offset this drop from the traditional sectors. And now, as you mentioned, you have also the traditional sectors rebounding. So you have a combination of structural and cyclical factors to support copper demand on the near term. And the thing is, the supply really isn't following this upside in future demand at all, because as you can see on the right chart here, you have peak supply for copper happening at best in 2024, and after that you have a decline in production, which Benjamin explained by the lack of investment, structural lack of investment, and the fact that you need 7 to 15 years to open a new mine. So this picture isn't going to entirely reverse in the years to come, and this could mean a huge supply-demand gap in the near term. So clearly, this paints a very significant upside potential for copper prices in the years to come.
Okay, thanks, Marion. And what about nickel, please?
Yeah, so nickel is kind of the outperformer for 2022 because it really, I mean, it's also hugely necessary to the transition, but it benefited especially from this very rapidly growing electric vehicle markets. As you know, that nickel is necessary for manufacturing electric batteries for vehicles, right? And the EV market was one of the few that wasn't really affected this year by either the slowdown in China or in the rest of the world. So it really benefited from this huge growth in the battery market. And I mean, there's still some space left for demand for nickel to grow a lot more in the years to come, because EV represents roughly 25% of sales in China, of car sales in China, but only 12% in Europe and 6% in the US market. And as we all know, the commitment and the new regulation toward electrification of transport have been very large from all the governments across the world. So we can only expect demand to grow much faster in the years to come. So this is for the demand side. And of course, the picture on the supply side is the same that for the rest of the metals, meaning that supply is very constrained right now, investments are lacking. As you can see on the left chart here, inventories have really collapsed this year and they are standing 80% below the 5-year average. So so production is constrained. And one other aspect is that we only can use class 1 nickel for battery production, which is the purest form of nickel available. It's pure at 99.7% or so. And of this, we produce only 1 million tons per year. And 20% of that is produced in Russia. So you have a combination of lack of investment, geopolitical factors, and a very rapidly growing demand that's gonna
they're supporting the markets.
Really are supporting the markets, yes.
Okay, thanks a lot, Mario. So Benjamin and Bill, to finish, we can talk about another aspect of metals, which are, of course, highly looked at by investors, so the precious metals. So maybe could you maybe give us also your views on gold and silver?
Yeah, of course.
And especially in this context of inflation.
Yeah. Gold had a difficult year in 2022 because first we saw the price going sharply up because of all the demand generated by the post-COVID recovery, and then because of the Ukraine crisis, people wanted to get safe, so they decided to invest in what is called safe haven investment, and gold is considered as a safe haven investment. So the price of gold hit a new all-time high at the time the war in Ukraine started. But then we saw the Federal Reserve, so the central banks of the United States, change its monetary policy and went from a really accommodative policy to a far more restrictive policy, raising interest rates. And as you may know, gold is an asset that has no return, and so as a consequence of it, when the return of other asset classes is going up, investors are getting out of gold progressively. And so this year, as real interest rates went sharply up, so the interest for gold went sharply down. And so that's what you can see on this graph. Yeah. You see that for since 2011, you can even go farther in the past, and you will still see the same correlation. You see on the blue line the gold spot price on the left hand, and the gray line is real interest rates, but inverted, 10-year US real interest rates, but inverted. So that means that when the gray line is going down, that means that interest rates are going up. This is exactly what happened this year. And so you saw, however, that at the end of the graph, there was a decorrelation between gold prices and real rates. I think that it is mainly due to the fact that because of all the geopolitical tensions, people didn't want to get out of safe haven investment. And so they decided to stay invested in gold. I think also that some people think that probably even if real rates today integrates the fact that probably the Fed will succeed in taking inflation back to 2%, people are not really convinced. And so I think that some people prefer staying on gold because of this. But let's talk about what could happen in 2023. I think that the Federal Reserve has only two options for next year. The first one is if it is serious about containing inflation at 2%, they will have to raise interest rates But the thing is that they will have to raise the interest rates sharply up. Why? Because a big chunk of this inflation is due to supply issue. And in fact, you can't solve some supply issue with raising interest rates, except if you destroy a lot of demand. And so I think that in that case, if Fed is serious about getting inflation back to 2%, they will have to raise sharply more than what is anticipated right now interest rates. And in that case, I think it will crush growth. And so people will probably adopt a risk-off policy in terms of investments. And so they will get out of stocks and bonds, and they will look for safe haven, which are usually dollar,
gold,
cash, and gold. And so I think this situation could be really positive for gold. The other option is if the Fed said, okay, we understand that inflation is not transitory at all. It's here to last, and especially because of the energy transition. And I think it could be a good way to get out of this situation, because what is really important for the Federal Reserve is to keep its credibility with markets. And so they have to find a good reason to change their target in terms of inflation. And I think that the fact that today more and more people are talking about the fact that the energy transition will be inflationary could be a good reason to change the inflation target from probably 2% today to probably 3.5% or 4%. In that case, people will have to revalue immediately the level of real rates to the downside. And as you can see on the graph, if real rates are going down, it's really good for gold. So in both these cases, gold is going up. So the only way for gold to go lower would be if we have a really strong growth, okay? Because in that case, governments will be able to cope with inflation and with debt also, because they have a lot of growth. This is really unlikely right now. So we do think that gold has all the good reasons to go up, and we think that we should probably see in 2023, or not later than the start of 2024, see a new all-time high on gold above $2,070 an ounce that we saw in 2022.
And you think the phenomenon is the same for silver?
Silver is a little bit different, because silver is more and more an industrial metal, because silver is the best conducive metal for electricity in the world. Mm-hmm. Okay, for that reason, it is more and more used in green technologies and low carbon technologies, especially for solar panels. We need silver to move electrons in a solar panel. So, in 10 years ago, we used to have between 20 and 25 grams of silver per panel, but as it was really expensive, they tried to reduce this, and today we came at a level of 5 grams per panel. But it is asymptotic, so that means that for the past 3 years, we stayed at 5 grams per panel. But we produce far more panels, as I mentioned before, today than 10 years ago. And so today, the demand for silver coming from the solar industry, which was inexistent 10 years ago, is today something between 14 and 16%. Okay, and we also use silver to make electric vehicle battery pack. It's not in the battery, but in the pack of battery. And the demand is today already something like 7 to 8%. Okay, and it should double between now and 2026. This is what you can see on the graph on your right. And so that means that in 2026, 2027, the silver demand for green technologies, which was 0 10 years ago, should be between 35 and 40% of the worldwide silver production. It's a game changer. And so we do think that for that reason, probably the price of silver should go sharply up. We are even more positive, more optimistic on silver than on gold. And also because of the graph you see on your left, which is the way the production changed in the past few years. And you can see that companies, mining companies, are not able today to produce as much as they produced a few years ago, because grades are going down and investment were insufficient. And so we have a constrained supply and at the same time a demand that grows really quickly because of the energy transition. So we are highly optimistic for the price of silver, and we think that we should see something like 28, maybe $29 an ounce. We are today around $24.5 an ounce. So we think that we could see the price going up by something like 20% this year.
Okay, so just maybe to wrap up, because we talked about copper, nickel, silver, and gold. So maybe the idea would be to give us some performance projection and see the landscape and the context of all these metals' behavior. So,
yeah, we think that for 2023, we should see all the metals going up, except maybe palladium, because palladium is in a challenging situation as palladium is mainly used today to make catalytic converter. And so as we see the market switching from internal combustion engine vehicles to electric vehicles, we could imagine that we will need less and less palladium. The catalytic converter industry represents 80% of palladium demand. So it's really important to know what will happen on this. We are still quite confident that there is some potential for palladium because if we develop electric vehicles, we also develop plug-in hybrid vehicle. And in a plug-in hybrid vehicle, you still have a catalytic converter. But what people don't know, often don't know, is that the catalytic converter in a plug-in hybrid vehicle is bigger than the catalytic converter in an internal combustion engine vehicle. So 10 to 15% more palladium in this kind of catalytic converter. So we do think that all in all, the demand should stay stable. And at the same time, we have some constraint on the supply also. So we think that we could see the price going up by 5%. For all other metals, we should see the price going up by 10 to 20%. And the metal on which we are the most optimistic right now is copper, because copper is really in a difficult situation with also some problems, some issues in the main producing countries in South America, which turned left these past years in terms of governments. And so they want to get a bigger part of the commodities business in terms of revenue. And so they are tougher and tougher with mining companies. And so there are some constraints, some mining disruptions on this. And so we are really optimistic for copper. We think that we could see the price going up by 30 to 35% this year.
So thank you very much. So globally, we can say that for the two products that you manage, energy strategic metal and precious metals, we are in a very positive and optimistic environment.
Yeah.
And it's a time to invest. Maybe it's a conclusion that we can give to our auditors.
Yeah, I don't know if Marion has a different opinion, but I definitely think right now that commodities could be one of the biggest performer of 2023. More than this, I think that this energy transition gives us a background that is really positive, because even in a situation where the growth should go down for several reasons, okay, we run out of time to make this energy transition, and so we will have to develop new solar panels, new wind turbines in order to reduce our CO2 emissions. And so even if stocks in the energy transition business will be affected by a slowdown in the economy, it's not the same for metals. We will still need more and more metals because we have to keep going further and faster on the energy transition. So I think we have a kind of resiliency here, and so we should see some good performance this year.
Okay, I would like to mention before ending that your team has just published a market outlook and a review for 2022 markets, which will be published and which is available right now, I think. So I can show it to the camera. So I think it will be on our website soon. And of course, it will be edited. So this is something that we will distribute rapidly. So commodities 2022 review and 23 outlook, market disrupted by the energy transition. So Marion and Benjamin, thank you very much. Goodbye.